I think you've got to look at fundamentals, and going into next year, really hasn't changed. So S&P Global Platts Analytics, we predict that global oil demand will grow by 4.7 million barrels a day into next year, reaching 103.2 million barrels. That's 700,000 barrels above pre-pandemic levels. So the demand is going to be there. I think coming back to the question about the reaction to the market and possible shutdowns of air transport and so forth. So yeah, sure, we're starting to see that, but you've got to look at the economic picture elsewhere. What's going on here? This battle between governments can't afford to lock down anymore. That's the fact. The British government can't afford to lock down anymore. Where's the money going to come to pay for all these bailouts, to put people back onto furlough, etc.? It's not there. You've got inflation running at 6.2% in the US. You've got inflation getting to really worrying levels here in the UK. So, there's only so much gas in the tank for governments to actually respond to this pandemic. So if you look at their policy response so far, it's kind of do as the minimum that we can do to keep things on the road. And then you look at OPEC itself. So, OPEC, they're producing oil they can at the moment. In our last survey in October, the 19 members with production quotas were 600,000 barrels a day under their allocation. So, compliance is 113.2% of what they agreed at their last meeting. And, I think that the last speaker there mentioned, these constraints around adding more oil at the moment. It's not just about investment. It's actually the practicalities of actually operating the fields, because, they all have COVID restrictions in place. They all have health and safety that they have to take care of. It's not just factories, banks. It's not just people working from home where life has become more difficult. It's actually operators in the oil field. So there's an awful lot going on, and there's an awful lot of reasons really for OPEC to kind of sit on its hands at the moment.
But in terms of actually something, Andy, we haven't talked about on air for a long time, is the level that the exchequers of the OPEC countries need in order to balance the books as well. How far below that are we now? Are we kind of near the equilibrium level?
I think it's a great question, and it's something that I'm looking at very closely. I mean, there's a couple of indicators that I think are really interesting. One of the things I really do always look at is the property rental market in Dubai. Dubai is a bit of a proxy for economic health in the Gulf. Rental market in Dubai, which is where all the international companies base their employees. It's a hub for the region. It's up 20%. So inflation is actually hitting the region. The fiscal break-evens in the region around, $70, $80. This is for the core Gulf producers, possibly higher. So they need to be generating this revenue. Yes, you've had a good economic bounce back, both in the Gulf and also in Russia, where economic growth in 2021's, I think, projected to go up by 4.7%. But, these economies need to generate cash. All the Gulf producers have dipped into their foreign exchange reserves during the pandemic. And especially in countries like the UAE, which needs to attract more internal visitors, they've diversified their economy a bit quicker. You've got Saudi Arabia is going through that journey at the moment. It needs to generate these foreign export earnings, and so they need crude trading above $80 a barrel to do that.
Andrew, I just want to revisit one of your comments there about economies, countries unable to afford for the lockdowns. If we look at it through the lens of the UK, which has been one of the most open economies, and some of the new measures that are being touted to be reintroduced could be isolation for 10 days if you've come into contact with a suspected case of this new variant. Doesn't that tell you that even though there might be pain around the corner and question marks as to how you pay for it, other governments, particularly in Europe, might go for lockdowns. Other countries where there are very close populations, where you may see enormous spread of this variant, may be forced into measures they don't want to take because they may have to contain the outbreak to protect health services. So isn't there still a threat to business activity and therefore oil demand next year?
Yeah, I think it's a fair point to make. But I think you can look at that from the other perspective that, that threat is also to inflation. What's caused this inflation? Yes, it's higher fuel prices, it's higher energy prices, but it's also the actual breakdown of supply chains, the breakdown of production chains and manufacturing as a consequence of all the restrictions that have been brought in place. And this is why central bankers step back and they say, look, all these pressures are temporary. One of the things I've looked at S&P Global Platts is definitely the impact of possible policy changes coming from central bankers and how that could act into next year as a tamper down onto demand, because inflation at 6.2% in the US, where it is in the UK, it's not sustainable. And central bankers are not going to be able to fall back on this narrative of this is temporary, we're going to stick to our plan. for indefinitely, because the political pressure is just going to build and build, and we're seeing that in the US and this was the major driver behind the release of SPRs to bring down the gasoline price.
Andy?
We're seeing it here in the UK. So it's this battle between central banks and OPEC, which I think is going to set some of the narrative for 2022.